Hello, everyone, and welcome for today's session. I'm your moderator for today's webinar. My name is Jean Setera, and I'm the Client Engagement Coordinator here at AMCA. For all the new joiners in this webinar, I would like to give a brief introduction of our company. We are from AMCA, Abdullah Al Marzuki Chartered Accounts, and we are an auditing firm here in UAE. With a decade of long experience, we are registered with the Ministry of Economy to operate as a licensed auditor and a tax agent from Federal Tax Authority. Again, I would like to thank all of you for taking the time to join us as we talk about in-depth guide to tax laws provisions and reliefs for corporate tax. This insightful session will focus on the key outline in Federal Decree Law number 47 of 2022 on the taxation of corporations and businesses. Ms. Kurt, our speaker for today's session, will provide us the comprehensive guidance on transfers within a qualifying group, business restructuring relief, tax loss relief, transfer of tax loss, limitation of tax losses carried forward. After the discussion of this topic, you can drop all your questions on our chat box, and Ms. Mariam will be joining us to answer all your questions by the end of the first half of this session. So without further ado, I will give the floor to Ms. Kurt so we can start the discussion.
So again, a very good afternoon to everyone who's already on our webinar. So just to give a pointers for today's webinar, as what Jean have mentioned, we will be discussing about the qualifying group, its definitions, conditions, parties of the transfer, the provision elections, as well as the record keeping that is required under the provisions of the law, and the business restructuring relief, as well as the tax losses, its definition, conditions, and the limitations as well. There are two kinds of groups when it comes to corporate tax law. So as what some of you might be aware already, there is what we call as a tax group, as well as a qualifying group. Both groups have different conditions to follow, provisions as well as obligations. So a qualifying group refers to two or more juridical persons where its members could benefit on corporate tax neutrality in a way that no gains or losses are taken into account upon transferring their assets or liabilities. Sorry, please let us know if the presentation or if our voice is audible. So to continue as what I have mentioned, a qualifying group refers to two or more juridical persons where the members could benefit on corporate tax neutrality in a way that no gains or losses are being taken into account upon transferring their assets or liabilities. So related taxable persons could be considered as a member of a qualifying groups where all of the conditions as what is stated on the presentations are met. So first condition is that the juridical person can either be a resident person or a non-resident person that has a permanent establishment in the state. It should be noted that a qualifying free zone person and an exempt person specified on the corporate tax law cannot be a member of a qualifying group as well. A qualifying free zone, on the other hand, can only be a member of a qualifying group if it has selected itself to be subject to the standard rate of corporate tax. The next one, further to that condition that I have mentioned, it should be noted that between the juridical person, there should be a direct or indirect ownership of 75%, or there should be at least a third party or a third person who could be not a party to the relevant transaction that owns, again, directly or indirectly, 75% of ownership in each of the relevant juridical persons. Lastly, the members of the group must also adopt the same financial year and must use the same accounting standard in the preparation of their financial statements. So the fulfillment of these conditions, as what I have discussed, will automatically bring the juridical persons to be treated as a member of a qualifying group. Now, the distinct difference of a qualifying group with a tax group is that the members of a qualifying group will still be treated as a separate taxable persons compared to members of a tax group. So moving on with the transfer within qualifying group. So as what I have mentioned, no gains or loss needs to be taken into account in determining the taxable income in relation to the transfer of one or more assets or liabilities between two taxable persons that are a member of the same qualifying groups. So for this one, there are two parties as what we could consider upon doing the transfer, which is the transferor and the transferee. So the transferor refers to the taxable person that transfers one or more assets and liabilities to another taxable person, which is the transferee. the transferee in return provides any consideration to the transferor. So to not have any gains or losses arising on the transfer, the assets and liabilities should be treated as being transferred at its net book value at the time of the transfer. So similarly, the value of any consideration paid or received against the transfer of the asset or liability shall be equal to the net book value of the transferred asset or liability. So the net book value of an asset is actually the cost of the asset reduced by the accumulated depreciation deductions, if there is any, allowed in respect of the asset. Now, if the consideration that was given in exchange of the assets and liability is in the form of another assets and liability, then the transfer should be considered as both separate transfer. So the application of this specific relief requires the relevant parties of the transfer to meet all the conditions for a minimum of 2 years. So these conditions include the assets or liability transferred cannot be transferred outside the qualifying group, and the relevant taxable person involved in the transfer must remain within the same qualifying group following the transfer. So the conditions are put in place to avoid the circumstances where a transferee have received an assets or liabilities and soon after exits the qualifying group, making the assets or the liability that was transferred to not be taxed. Whereas normally the transfer should have been taxed for corporate tax purposes if the relevant party is not a member of the qualifying group. So if these conditions are not met by the member, the transfer of assets and liabilities should then be treated as having taken place at the market value at the date in which the first transfer took place, which would directly affect the taxable income of the transferor and should be included in its tax return. So in cases where the transferor ceased to be a member of a qualifying group, any gains or losses that would have accrued to the transferor should be attributed to the transferee. Hence, necessary adjustments on the taxable income during the relevant tax period must be made to reverse any depreciation, amortization, or other change in the value of an asset or liability that has been previously adjusted by for this specific transfer. So for the members of the qualifying group to avail of this relief, as per Ministerial Decision number 132 of 2023, an election must be made by the transferor at the time of the submission of tax return for the relevant tax period during which the transfer took place. So the election shall be irrevocable and will take effect on the relevant tax period and subsequent tax period, unless the authority, having regards to the circumstances of the case, determined otherwise. So the provisions, as I have discussed as well, shall apply to all transfer of assets and liabilities held on capital account. By doing an election as well, both the transferor and the transferee must maintain the relevant documents as prescribed on the specific decision. So basically, it refers to the record of the agreement to transfer the asset or liability at the value as prescribed. Another relief that is available in corporate tax is the business restructuring relief. This specific relief eliminates the corporate tax impact of certain transactions undertaken as part of restructuring or reorganization of a business. So transactions taking place during a business restructuring, such as mergers or demergers, would normally result to taxable gains or loss, regardless for the ultimate ownership of the business or taxable person do not change, or the original owners of the business or taxable person retain an ownership in the restructured business. To proceed with the restructuring transactions undertaken for a valid commercial or other non-tax reasons, the business restructuring relief allows a certain type of restructuring transactions to be done in tax-neutral manner and eliminates the corporate tax impact of certain transactions undertaken as part of the restructuring or organizations of a business. So the business restructuring transactions that can benefit or that could fall within this specific relief are the business merger, legal mergers, as well as partial or full demergers or the legal demerger. A business merger is a simple example of it is when a natural person converts its business or a business activity into a legal or incorporate entity. So meaning to say this occurs when a taxable person transfers its business or an independent part of a business to which the person receives an ownership interest in exchange of the transfer that was made. Now, a legal merger, on the other hand, is a restructuring transaction where the taxable person, referred to as a transferor, transferred its entire business to another taxable person under universal title, after which the party initiating the transfer is dissolved by or ceased by to exist under the law without going into a liquidation, and its shares of ownership is cancelled by the law as well. So the transaction could also result to the owner of the transfer to be the owner of the another taxable person, which is the transferee. Lastly, a legal demerger could be a partial or full legal demerger. So a full demerger is the instances where the transferring party ceases to be a taxable person as a result of transferring their entire business to another person, or at least two taxable person who is either currently a taxable person or would become a taxable person as a result of the transfer. So again, the same as qualifying group relief, this specific relief could be applied provided that all the conditions as what is stated on the presentations are met. So the first one is the transfer is undertaken in accordance with and meets all the conditions imposed by the applicable legislation of the state. So the restructuring transaction must be carried out while complying with all the applicable legislation in the state or the requirements of federal or emirate level laws and regulation. The next condition is the taxable person should be within the scope of corporate tax. Hence, it can either be a resident person or a non-resident person that has a permanent establishment within the state. The third one is none of the persons are exempt or a qualifying free zone person. And the fourth one is the taxable person must have the same financial year end and prepare their financial statements using the same accounting standard. Lastly, the transfer is undertaken for a valid commercial or other non-fiscal reasons which reflect economic reality. So the last point emphasized that the transfer should be undertaken for a valid commercial or other non-fiscal reason which reflect the economic reality. So again, for this specific relief, there are two parties to the transaction that would happen, which is the transferor and the transferee. So the transferor refers to the taxable person who transfers a business or an independent part of its business. An independent part of a business refers to a part of the business that may be operated independently and separately from the other business of the taxable person. So the transferee is the one who is gonna receive this business or independent part of the business, and could be a person who is either a taxable person or would become a taxable person as a result of the transfer. In exchange of the transferee further issues consideration in the form of ownership interest or shares, which could be in the form of ordinary shares, preferred shares, redeemable shares, membership, and partner interest. So the other circumstances wherein, since it is not always that the taxable person who is the transferee is the one who's going to receive the ownership or interest. So there are also other scenarios where the ownership interest or the shares is issued by a person other than the taxable person, which is the transferee, provided that the person have a direct or indirect ownership of at least 50%. So the same thing, the ownership interest or shares is received by a person other than a taxable person, which is the transferor, provided that the person have a direct or indirect ownership of at least 50%. And the third scenario is where no shares or ownership interests are received by the taxable person who is a partner in an incorporated partnership that is treated as a taxable person, where no gains or loss should be taken into account in determining the taxable income, irrespective of whether the shares or ownership interests are received by the partners in the unincorporated partnership, or whether all the partners in the unincorporated partnership are taxable persons. So to apply for the provision of the business restructuring relief to the transfers meeting the conditions as what I have mentioned, an election must be made by the transferor and both parties must maintain the necessary records correlating to the agreement made to transfer the business or business activity at the value that was prescribed. So certain provisions must be applied and observed upon doing the transfer under the business restructuring relief as well. The first one is the assets and liabilities transferred must be at their net book value for corporate tax purposes at the time of transfer, which would result to neither a gains or loss arising from for corporate tax purposes on the transfer of assets and liabilities in the context of qualifying restructuring transaction. The next one is the total value of consideration received by the transfer cannot be recorded as exceeding the net book value of the assets transferred and the liabilities that was assumed, less the value of any other forms of consideration that was received. In a different scenario where the transferor ceased to exist, the value of the consideration received by the transferor shall not exceed the book value of shares or ownership interest surrendered, less the value of any other form of consideration that was received. And the third point, any unutilized tax losses incurred by the transferring taxable taxable person in a tax periods prior to that specific transfer may subsequently become carried forward tax losses of the transferee, given that the transferee continued to have the same business or business activity that was initially conducted by the transferor prior to the transfer. So based on the ministerial decision number 133 of 2023, to assess whether that transferee took over the same business or business activity, it should be considered that the same asset used by the transfer must be used by the transferee as well. There should not be any significant changes on the core identity or the operation since the transfer. And where there have been any changes, these result from the development or exploitation of assets, services, processes, products, or methods that existed before the transfer happened. So on the case where only an independent part of a business is transferred, the transferee can only utilize the proportionate amount of tax loss in respect of the business. Aside from the previous provisions that I have mentioned, there are some additional certain conditions that must also be embodied by the transfer, which are the market value of any other forms of consideration received in addition to shares of other ownership interests do not exceed the lower of the net book value of the asset and the liabilities transferred, or 10% of the nominal value of ownership interest issued. All the conditions that I have mentioned for relief must be met by the involved parties for a minimum of, again, 2 years. So this requirement is meant to provide assurance that the business restructuring relief will only apply to business restructuring transaction, as opposed to providing for a tax neutral transfer of assets and liabilities as part of or in anticipation of an ordinary sale transaction. So specifically, the ownership interest or shares in the transferor or transferee could not be transferred to a person outside the qualifying group within 2 years of the initial transfer. In addition to that, a subsequent transfer or disposal of the business or the independent part of the business transferred under the business restructuring relief is prohibited within 2 years of the original transfer. So again, failure to meet the condition will result to the treatment of the transferred business or independent part of the business as having taken place at the market value at the date on which the first transfer took place. Wherein, by doing so, any gains or losses that arises as a result of the transfer shall be taken into account in calculating the taxable income of the transferor and shall be included on the tax return. So on case where the transferor ceased to be a taxable person or is a natural person, any gains or losses that would have accrued to the transferor shall be attributed to the transferee. Therefore, the taxable income must be adjusted accordingly to reverse any depreciation, amortization, or other change in the value of an asset or liability that has been previously adjusted by the transferee for this specific transfer. So for the third subtopic, which refers to the tax loss. A tax loss could be defined as the negative taxable income in a specific tax period. It arises when the total deduction of a business can claim are greater than the total income that is subject to tax for the relevant tax period, resulting in the negative taxable income that I have mentioned. So the tax loss relief allows these losses to be set off against the taxable person's taxable income in the subsequent tax period, given that it meets the certain conditions. So the relief ensures that businesses are taxed consistently, irrespective of the profile of their profits over time. Although the relief gives way for the utilization of tax losses, the amount to be offset against the taxable income for any subsequent period should be limited to 75% of the taxable income for the relevant tax period before any tax relief. So for example, if the taxable income for a tax period is around 1 million AED, the amount of tax losses that can be used to reduce this taxable income cannot exceed 750,000, being the 75% of the 1 million AED, even that specific taxable person has more tax losses that they could utilize. So if the available tax losses was not fully utilized in a relevant tax period, such losses can be carried forward to a subsequent tax period until the tax losses are fully utilized. And where there are accumulated tax losses brought forward from prior tax period, such tax losses must be used to offset against the taxable person's taxable income first before any excess amount can be utilized by other group of companies or can be carried forward. Aside from the ability of the tax losses to be carried forward and utilized for reducing the taxable income of a taxable person, the tax losses can also be transferred between resident persons subject to meeting certain conditions. So the transfers can cover both tax losses arising in a current tax period and those that was brought forward from a previous tax period as well. So for the first condition, both taxable person involved must be a juridical person that is considered as a resident person for corporate tax purposes. The second condition is one of the main condition which refers to the threshold of common ownership required for between the juridical person, wherein either of the person must have a direct or indirect ownership interest of at least 75% in the other person. This condition is also extended and is required to exist from the start of the tax period in which the tax loss is incurred to the end of the tax period in which the other taxable person offsets the tax loss transferred against its taxable income. So the fourth condition is that none of the person are exempt person or a qualifying free zone person, and both person must have the same financial year end or prepare their financial statement using the same accounting standards as well. So the provisions as initially discussed shall be applied. Like for example, the limitation of the amount, the 75% limitation that I have mentioned will be applied once all of these conditions that I have discussed are met. And the taxable income of the taxable person to which the tax losses is transferred shall be adjusted accordingly. And similarly, the tax losses available to the tax person who initiated the transfer should reduce its available tax losses. The last and highlighted condition for a tax losses to be carried forward from one tax period to a subsequent tax period is that there should be either a continuity of ownership or a continuity of the business or business activity of the taxable person. So this is to avoid the person not present to which the tax losses are incurred benefiting from this specific relief given on the utilization of these losses. So on the continuity of ownership requirement requires that there should be a sufficient continuity of ownership where the same person or persons must have continuously owned an ownership interest of at least 50% in the taxable person from the beginning of the tax period in which the tax losses are incurred to the end of the tax period in which the tax losses are to be utilized. On the other hand, the continuity of the business refers to where the taxable person continued to conduct the same or similar business or business activity following a change in ownership of more than 50%. So, identifying whether a business activity is similar does not implicably or technically mean similar kind or type to the previous business or business activity. Rather, one should consider all of the commercial operations of the previous business or business activity and compare that of the new business or business activity to determine whether the two activities are similar. So, to assess whether the same business is being continued, the taxable person must use some or all of the same assets as before the ownership change. Also, the taxable person has not made significant changes to the core identity or operations of its business since the ownership change. And where there have been any changes, this result from the development or exploitation of assets, services, processes, products, or methods that existed before the ownership change. So if a business or business activity changes its core characteristic, or if there is a change as a result of either the commencement, the acquisition, or the cessation of the activities, then the new business or business activity may not be considered to be the same or similar to the previous one, which would result to this specific condition not being met by the specific taxable person. So that's it for the discussion for today's relevant topic. You may now send your questions on the message box and we'll have it addressed in around 5 minutes at the question and answer session.